Hey everybody, this is our TradeSmith weekly video newsletter for May 23rd. Lots of action. Things are working exactly as we predicted. Let's get right into it. And of course, I predicted absolutely 100% certain that I would show you this disclaimer. And in fact, I actually am. All right, I've got a lot of lines on here. Let's go through this quite a bit. So first of all, you can see the three humps at the top. That's the potential head and shoulders top. The orange straight line underneath that is what's called the neckline. And a break below that would mean that the head and shoulders is a valid head and shoulders. Now, what's happening is that what you look for in a head and shoulders is you look for volume to decrease as we go through the pattern. Now, that was true until this last week. And you look down at the bottom, you can see my two green arrows, one showing how the volume is going down, but now the volume's going up a little bit. So it's very possible that this head and shoulders top may fail. Now, the price actually broke through the neckline on Thursday, but turned around, rebounded, and bounced up on Friday. So we don't count that as a break. It has to close below that line. I then have two parallel green lines up at the top. Oh, so the head and shoulders, we need to close below about 2030 here on the S&P 500. The right shoulder, which is about 2085-ish, if we close above that, then the pattern has failed, and I'm going to be much more interested in going long at that point because a failed signal is a signal. And if the head and shoulders fails to occur, then that's a pretty bullish sign. Okay, let's go to those two parallel green lines that are slanting down. We're in what's called a flag formation at this point. And a flag formation, well, it looks like a flag. The flagpole is the rally we made from February into April, and the flag itself is in those two green lines. Now, once again, though, volume is supposed to go down as we go through a flag formation. It was doing that. But the last week, it looks like it kind of went up. We have to really monitor that next week. Now, if the head and shoulders is true, and if it does break that, then I think we're going to go down to that 1950 orange line that I've drawn down there. So what I like about all this is we now have some clear-cut points that we can put on some trades and start to have a firm attitude in the market. A break above 2090, a close above 2090, I'm going to be much more likely to go long. Obviously, we need to see what the conditions are at the time. A close below 2030, and I'm going to want to go short. So we've now got it narrowed down to some very clear scenarios. All right, same thing with the Dow Jones. Here on the NASDAQ, a little bit different situation, as you can see, but the NASDAQ is just weaker. That's all. That's the thing to remember, is the S&P and the Dow are leading on the upside. Seasonality, look at that. It came down on Thursday and exactly hit our green bar, but rebounded on Friday. This is the IWM, or the Russell 2000. This is what the indicator we use for our seasonality. So you can see we are very, very close to switching from bullish seasonality to bearish seasonality. Usually, the bullish seasonality ends at the end of April, so it's kind of long in the tooth, doesn't usually go into May, and certainly May has been a down month so far, so the seasonality could easily be over. If it does, we'll go from having extra large positions on, which made us a lot of money in February, March, and April, we'll go to having just teeny positions on, or half-size positions on. So I'm watching this one really closely, and it should give us a signal this week. Seasonality here on the longer term from Stock Trader's Almanac, highly recommended. Look over here towards the middle of May, and you can see that the top blue one, those are election years, should start to rally the market. We should continue to rally up until September. But if we take the down trifecta, which means it was very weak in late December and early January, then this year doesn't look so good. And this down move in May could continue down all the way to July. The yield curve, we should be getting a bounce out of the yield curve. Remember, this is a 1-year forward predictor, and it suggests we should be starting to see some strength here as we get into the beginning of June. We'll see. Asset allocation, as you can see, boy, they don't know whether to put money into bonds or stocks, so it's really telling us not a lot of anything right now. Risk appetite, on the other hand, had been plunging, but over the last week, the market showed a little bit of strength. It showed a little bit of friskiness. All right, global shares. Why bother? The U.S. market is much more bullish than the global shares, so I'm pretty much not recommending anything except the Greek shares. Now, I've been highlighting this quite a bit. I've been highlighting it for a couple of months. We were down at 560. We're at 860 now. That's a 60% return. We're up about 30% from when I pointed it out to you. Greek shares are going to do great. But Courtney, there's all this disastrous news and strikes. And yeah, you know what? That's all true. But first of all, the IMF is coming in and is going to take over and bail them out again. That's pretty much certain based on my reading of the news. The second thing is all the bad news. Everybody knows it. So there can only be good news for the Greeks. So this is an area I'm still strongly bullish on. Bonds have done exactly what we predicted. Right now, we should expect them to go back down and trade down to the 127, which is the bottom of this big rectangle formation. But let's take a look at the fundamentals. Now, take a close look at that chart. We're in the middle of those two green lines, and I'm saying I think we're going to go lower. And not only do I think we're going to go lower, but I think there's a very good chance that we're going to break that 127. We're going to get out of this rectangle formation on the downside. Here's why. All of my bond key indicators are calling for higher interest rates. Gold is the top one, pretty consistently moving higher. The CRB index is this one in the middle. It's consistently moving higher. And the blue line down at the bottom, well, okay, that one's kind of sideways. But still, 2 out of 3 are suggesting that we're going to have higher interest rates. And look, obviously things can change over the next week or so, but as we sit right now, we're definitely going to go down to that 127 level, and there's a very good chance we're going to break down out of that rectangle formation. The dollar broke above the resistance. I told you that it would get up to the resistance. Now it's broken through. It hasn't broken through decisively. As you can see, it's just poked its head above the green line. But nonetheless, it looks like it's looking pretty good. The market really believes that the Fed's going to raise interest rates more and more than they did before, and that's very supportive of the dollar. So look for the dollar to move higher. Well, if the dollar moves higher, then gold should move lower, and that's exactly what it's doing. Now, I haven't shown you my critical key fundamental factors yet. Now, one of the things is, if I just look at the chart pattern, it looks like another flag formation, which is bullish. But unfortunately, the volume, which I didn't show you here, is not going down. So at this point, I don't think it's a valid flag formation. Let's look at our critical indicators. Kind of a mixed bag, but 2 out of 3 are pointing down and only 1 is pointing up. We have to say that the pressure is that gold will not rally over the coming week or so. So, stronger dollar, weaker gold, to be expected. Oil, on the other hand, is holding up very well in face of the stronger dollar. Normally, a strong dollar hits the oil market. But if the oil market can rally during a period of bad news, such as the dollar going up, then that shows that there's actually very good strength in the oil market, and the production cutbacks that we're seeing in the U.S. are really starting to tighten supply. So, I guess I have to be on the bull side here. All right, that's it, everybody. Thank you very much, all you freebies there. Hopefully you can turn into a fully paid up member. Go to that website up at the top, sign up. You're going to love it. 100% money back guarantee, by the way. If you don't like it, try it for 30 days. If you don't like it, you get your money back. It's no big deal to us. All right, thanks very much, everybody. We'll see you next week. And all you fully paid up members, we'll get going here in just a second. Take a deep breath and relax.